Like there's only one way to do that, which is to treat people really well. When I say people, I'm not just talking about investors or maybe even employees. I'm talking about how do you treat your vendors? How do you treat your communities? How do you develop a reputation for being a place that people want to work and people want to work with you? So I mean, that's our philosophy is just, get rich slowly and over a long period of time is the best way to try to get rich.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am your host for today, Nathaniel, along with my partner, Dan Weiss. And today we have Brent Beshore of Permanent Equity joining us today. I'm really excited about this, in case you guys can tell with my big smile. I don't normally have this on the podcast, so this is a big one. So today I'm going to be your host. Tim will not be joining us today, so I'm hoping to get this first part right. So bear with me. So, as we always like to say, if you like our podcast, just go there and subscribe. You'll like it. Trust me. So with that, I'd like to welcome our guest, Brent. Brent Beshore is the founder and CEO of Permanent Equity, a Columbia, Missouri-based private equity firm. Permanent Equity partners with family-owned companies, has over $350 million of long-dated capital, and transacts using no debt. So with that, Dan, could you kick us off with questions?
So Brent, again, thank you for joining us today. It's been a number of years since we've seen you with life events, as we were saying, on the mean streets of Omaha for a Berkshire meeting. We're familiar with this entity to an extent, but the audience obviously is not. Can you talk a little bit about how the concept of permanent equity came to be? And then how it is different today.
Yeah. I mean, well, first of all, thanks guys for having me on the podcast, and it's a pleasure to be here. So Permanent Equity got started haphazardly, like I think most things, and evolved haphazardly in the meantime. So it started off, I was getting my law degree and my MBA, and met my wife who's getting her PhD, and started a business, and that led into starting a couple other businesses. And then I met somebody who said, hey, you should meet this guy. He just got left at the altar for the second time. And I took that to mean I should try to go buy his business, because why else would you tell me that? And so I don't know, I look about 25 now. I looked about 14 then, and sat across the table from this guy and tried to buy his business. And he told me there's no way. And 7 months later, he called me back up and said, okay, I'll give it for the price you asked for. We got to close all cash 60 days from now. And so still in that company today, called Media Cross in St. Louis. That was really the first foray into acquisitions. Prior to that, never worked at another firm, had no background. No one taught me how to do this. I owe most of my career to Google. So yeah. And then since then it's evolved and just do more of what works and less of what doesn't. So from that acquisition, did well with it, use those cash flows and rolled them into acquiring a number of other companies. And then let's see here, almost 4 years ago now, raised $50 million in very long dated capital. It's technically a private equity fund structure, but it has the longest lock, I think, in private equity history. So we have the capital locked for 3 decades. And then we raised $300 million in 19 and 20. So we've got plenty of dry powder, and we've got 11 companies in the portfolio, coast to coast. Trying to think, basically in comparing us to traditional private equity, it's comparing apples to oranges. We typically use no debt in our transactions. We like to keep leadership in place. We like to partner with people for a very long time, and buy with no intention of selling the business. So, functionally, we like to keep these businesses family owned, even after we own them, and treat people really well and try to all win together. If that sounds odd, it is in private equity. So private equity typically is going to buy something, lever it up, strip it to get cash flow up, and then sell it to somebody else within a fairly short period of time. So we do things very, very oddly, but it's our style. We like it. Sticking to it.
That's interesting. When you say that it's long dated in history, the longest dated in history at 30 years, but then you say that you're never going to sell any businesses that you buy, how would that work?
Yeah, well, first of all, I didn't say we would never sell. I said we have no intention of selling. So there's a difference between those two things. We think that there's good reasons to sell and bad reasons to sell. If there was never a good reason to sell, as I say to sellers all the time, then why would you be selling, right? So there are certain times when it's good and certain times when it's not. We certainly never want to be a forced seller. And 3 decades is a long time to figure out how to make sure you're not a forced seller. And at the year 25 mark, we have the ability to continue the fund on further and extend the time horizon with a majority and interest vote of our LPs. So the initial term is 3 decades. We can certainly extend it longer than that. I don't know, 3 decades from now, I'm going to be in my late 60s, early 70s. So we'll see. Maybe I'm tired by then. The team's pretty young though. Maybe they can take it over and figure it out.
I'm curious on 2 things you mentioned in those statements that, right, keeping in mind, we have a number of clients, and I'm sure people in this audience that have been involved in private equity, not quite like you're talking, but most people have no clue about what we're talking about here today. And so one of which is, can you dive a little bit deeper into what we typically see with the usage of leverage and the benefits and perhaps challenges that come into play that you see not doing the same? And I'm also curious too, you mentioned that you try to keep these businesses family owned. You talk about maybe some of the benefits in doing so, why that is the objective, or at least the intention.
Yeah, it's a great question. So maybe let's talk about debt first. So debt's an amplifier, right? That's not a source of returns. That's a source of amplification of returns. And no operating company gets better operationally, more durable, higher quality as a result of putting on debt. So you're always taking out, if you want to use the analogy, taking steel out of the bridge, right? It's just a matter of how much. And our philosophy on it is that compared to traditional private equity, which is typically using 3 to 7 turns of debt, depending on kind of the situation, 3 is kind of the starting point. We think that having the flexibility to use the cash flows, not to have to go back to a lender and to pay down debt, we think that gives the company a lot better opportunities to reinvest and treat people very long term. If you talk to anybody who's been traditional private equity, especially on the financial side, they'll tell you horror stories of having to sort of beg, borrow, and steal to keep a company alive. And it was just because they over-levered it. Look, the world's unknown. The future's unknowable, right? If we knew exactly what was going to happen, of course you use max leverage, right? I think that the question is how much value is there in optionality, and how you can, if you're sort of your North Star is to treat people really well, is the use of debt, especially from an operating perspective. I mean, we're not talking about operating debt as in, buying a building or expanding the plant or, financing receivables. What we're talking about is, transaction debt, is putting transaction debt on a company, a good way to set things up. And our argument is it might be if you're only going to own it for a very short period of time, which is the traditional private equity model of, maybe 3 to 5 years at most. And look, you just can't make good long-term decisions with short-term capital. So, I would say kind of the combination of low leverage to no leverage allows for greater flexibility. It allows for the breathing room to treat people well and treat people long-term, gives you optionality about what to invest in. And then a longer time horizon allows you to make good long-term decisions. So what we tell our company owners is, our company operators is don't think about what we want. Think about what's in the best interest of the company. And if you're doing that, then we're all going to win together. And think about that only.
Very well put. I think that I wish that all operators were like that, unfortunately. But I guess that's what gives you guys that leverage to partner with certain individuals, which I think that we're going to get more into later on. But in the meantime, I did have a follow-up question to the 30-year limit that you mentioned. Was that due to some form of legal constraint? Could you have gone longer if you had wanted to, or was that more of like a negotiation with the potential investors that you were speaking to, where they were saying that they wouldn't go longer than that?
Yeah, it's a good question. So on the very first fund, we asked for 50 years and got 50 years negotiated. And so how do we get from 50 to 27? It's a great question. I'm glad you asked it. We got there because the lead lawyer for the family flipped out on us and said there's no way that he'd allow his client to invest in us. And, I had asked myself in the moment, is that the hill that I'm ready to die on? Because we weren't going to probably raise the fund without them. And so I said to the lawyer, well, what's the longest you've ever seen? He said, one time I saw 27 years with 3 one-year extensions. And I said, sounds fantastic. We'll take that.
Could you tell us, Brent, when you're dating a business and looking to perhaps purchase, what attributes are permanent equity really looking to find in those businesses today?
That's a great question. So we're industry agnostic for the most part. We have maybe a few industries that we have a little bit of a prejudice against. We're not huge fans of retail. Oil and gas has always been something that, frankly, we just don't know what the price of any commodity should be. So we don't want to stake the business on it. There are harder business models and easier business models, is what I would say. But for the most part, we think that in every industry, there's little niches that you can carve out that are really underappreciated and underserved. And so we're willing to pretty much look at almost anything. In terms of the attributes that we're looking for history and durability. Things that are attractive to us are things that haven't grown a ton recently. Not to say that growth is bad by any means. It's just usually what goes up can come down pretty quickly. And growth, if you've never been an operator, you don't know what this means, but growth creates a lot of problems. So every time you grow, you break all your systems. You have a lot of let's put it this way, is a nonlinear relationship between the politics of an organization and the size. And the bigger it gets and the more quickly it gets there, typically the more there are going to be cultural challenges that pop up and present problems for future growth, or even sustaining that level of maybe revenue or gross profit or whatever the metric that you want to use. So for us, we're looking for a fairly stable organization that's heavy cash flow. We like organizations that produce more cash than they can reliably put to work back into the business. Ultimately, we'd love a business that just had an unlimited capacity for reinvestment, but that's pretty rare. Usually you're going to find, asset light companies that you can compound capital a little bit into them. But like as an example, we own the nation's largest swimming pool builder. And what would we do to reinvest that cash back into growth? Like more laptops and few more pickup trucks. It's not like we have an opportunity to redeploy that capital back into the business at a high rate of return, at least for much of it. So what we're looking for in these businesses is the sustainability to keep doing what they're doing, to not be technologically disrupted, for it to be unattractive to outside entrants. When we think about the businesses we want to get involved in, we want there to be only economic actors in play. And so as soon as you bring in non-economic actors for whatever reason, we think that's a pretty challenging competitive positioning to be in. So we're, we have some other heuristics that we use. We won't buy a business from somebody who's not already rich, because if they didn't get rich doing it, we're not going to. Things like that we toss around the office. But honestly, we're looking for closely held management leadership with a lot of stakes in the business. We like to keep people rolling forward into the new deal and to keep them on board. And so typically it works out best if there's under 5 owners. It's hard enough to get a deal done with one person, let alone 5. We've certainly done it, but there usually needs to be one dominant or maybe 2 dominant owners of the business. Other than that, we're open. We just try to be thoughtful and kind towards them and really try to understand what their goals and motivations are. We're not big on people selling us their business when they're young and are going to take that capital and reinvest it into a different business, because obviously they're in a superior position of knowledge to us. And if they're selling the business to us, they think they're getting a better deal. And if they think they're getting a better deal and they're going to do something else with it economically, then probably means we're not going to get a good deal. So we're looking for somebody who typically is wanting to get out of business in general or take major steps back. Yeah.
I would imagine that you are going to agree with this statement, and so then I have a question regarding it. And the statement is that when, suppose more than not, you're engaging into businesses that are not as prepared as perhaps you'd like to see in selling the business to begin with. And we, in fact, you have a very nice book that we pass out to a lot of clients that speak about preparing steps, checklist to get to a spot that makes that business attractive for succession. And it'd be really wonderful if you could highlight some of that process, because that's been our experience, is that most businesses we talk to, regardless of their size and their maturity, are not as prepared as we would like to see them to go to market like this. And within that very loaded question, are there certain attributes that just turn you off entirely?
Yeah, it's a great question. And, obviously you guys get what's going on, because I joke all the time that all businesses are loosely functioning disasters that happen to make money. When you try to sell a loosely functioning disaster to somebody else, it's going to be messy. So, the book's called The Messy Marketplace. Came out with it, I think it was 2.5, 3 years ago. I can't remember exactly when we came out with it, but it outlines, what the first 5 to 7 hours of conversation that we want to have with every seller. And really, we just wrote it because there was nothing else out there that we could pass along that we felt comfortable with. So, in terms of what we often see is sort of the non-negotiables, and how would we prepare? I mean, I would say it's just a lot of this is just common sense. Like if you were buying a business, what would you want the other person to have together, right? You'd probably want to have a pretty accurate financial statements for the last 5, 7, 10 years. You'd want to understand how the leadership team interacted and how decisions were made. You'd want to understand, how they think about cash flow and how they think about managing the finances of the business. You'd want to understand hiring, all the typical things. I mean, nothing's rocket science. And really there are very few deal breakers. I would say that for us, deal breakers just outright lying. We've had that happen more often than you'd probably expect. And sometimes when I say lying, there are sellers and leadership teams that will tell us something that isn't true. That's not necessarily lying, right? Lying is a willful misinterpretation or misinformation. And we're fine with somebody saying, "Oh, I think that our largest customer is 27% of our revenue," and it ends up being 31%. That's fine, right? It's when you say, "Oh, we have no customer that represents over 5% of revenue," and then you've got a customer that's at 65% of revenue, which is a true story. Or you've got, an example of this is we looked at a company recently in the construction space who claimed that they had $6 million of earnings, and they even had a sell side Q of E, which are not worth a lot, as we found out, that said that they had $6+ million of earnings. And then we said, "Okay, guys, can you help us understand? You started the year off with $50,000 in cash. You ended the year at $30,000 of cash, and there's no distributions. Where did $6 million go?" And they said, "That's a great question. We will get back to you on that." And then they came back and said, "Well, we did a lot of adjusting." We said, "Well, that's fine. Just bridge it for us. Show us where the adjustments were." And they're like, "Yeah, we can't really do that. But it's there. Just trust us." So things like that, being able to show a buyer that, maybe reality is what it is helpful. So
that's a great answer. And I love the example. And that does happen, right? Eventually you pay the price. It comes back and haunts you. Very few times where that's not the case. Could you talk a bit about why a seller would want to consider permanent equity and or other private equity or private buyers? And then, of course, where you see are the key point differences between permanent equity, as in your company, and other options.
Yeah, I mean, so why do people sell? I think is the base question, which, I think there, again, are good reasons to sell and bad reasons to sell. I think good reasons to sell are you want to do something else for whatever reason. Maybe there's death, divorce, health issues. Want to spend more time with family. We've had a seller say, I want to become a painter. Like, that's great. I think those are all good reasons to sell. Bad reasons to sell are you're trying to take advantage of somebody. You're trying to offload, a business in decline and claim it's not in decline. You're trying to misrepresent yourself. I mean, I think those are all bad situations. Timing the market. Hey, I've heard multiples are really high. Let's just be honest, right? Like, keeping a business that's healthy and thriving is always going to be more profitable than selling it. Always. Like, there's no exceptions to that. So if you're trying to sell to make more money, that's the wrong way to look at it. You're always going to make more money keeping your business. Now, why would people choose us versus somebody else? I mean, we are really a weird situation. So, I mean, we're not right for almost everyone. The people who we are really want to attract are people who care deeply who buys the business, care a lot about their employees, about the trajectory of the company, want it to typically be run how it's historically been run. So I have never, literally in my entire career, met a company that's thriving in the small business world that has a bunch of debt on it. Like, literally, I've never seen it. I've never seen a company come to us and want to sell the business that has a bunch of debt on it. Frankly, they don't exist because you're playing with dynamite. You don't build an enduring organization by putting a bunch of debt on it. So if you care about not having a bunch of debt put on the business and changing the operating procedures as a result of that, then we become more attractive. If you, I don't know how to say it, like, we have a different way of doing business than most people do. And when your time horizon is functionally in infinity, you're able to create win-win situations. You just can't create when there's short time horizon. And so, if all you care about is getting the most cash at close, which, man, this is going to sound so cynical, and I don't mean it to sound cynical. This is really the truth. And this is said from a position of non-judgment. I would say 95% of people just frankly don't care about anything else other than getting the biggest check at close. I mean, the joke that we have in our office is, look, money's not our most important thing unless you're not the highest bidder. So, it really does come down to that for most people. Now, there are some people, and of course, the question is always, what's the discount you're going to take and what are the terms? We try to do is say, look, we're not trying to get a discount. We'll pay in the ballpark. We may not be the highest bidder. We'll pay in the ballpark of what everyone else is paying. We're probably going to want to structure it in such a way that we want all our interests to be aligned for the long term. We want a really successful transition. And we want to have the flexibility to do things with the business that if the business gets in trouble right after we buy it, that's okay. We'll survive it. And I think that's where there's a big difference between typically us and other people in that way.
And this is why you mentioned the importance, if possible, on keeping these businesses family owned, because you want to keep the culture, the spirit, what's important to those people intact. You don't want to disturb that element.
Correct. And I mean, the investors we have are almost exclusively families. When we have a couple university institutions that are also phenomenal partners of ours, but for the most part, these are families that made their business, made their money being in businesses like the businesses that we acquire. And they get it. they want what we want. That's why they've signed up for the structure that we have. So everything's just perfectly aligned. We really haven't talked about our fee structure, but we have a cash flow based fee structure. We have no fees of any kind, no reimbursements of any kind. So there's no cash that comes from the LP to the GP outside of we take a percentage of cash flow above a hurdle. And what that does is it's really amazing because it aligns our interest completely with our investors and completely with our operators. So there's no deviations in outcomes, right? Everyone should be completely aligned in what's going on and completely like eyes on the prize and what we're trying to do. We're trying to create a durable river of cash that comes out of the company in increasing quantity and quality for the long term. Like, there's only one way to do that, which is to treat people really well. When I say people, I'm not just talking about investors or maybe even employees. I'm talking about how do you treat your vendors? How do you treat your communities? How do you develop a reputation for being a place that people want to work and people want to work with you? So, I mean, that's our philosophy is just, get rich slowly and over a long period of time is the best way to try to get rich.
So throughout this conversation so far, you've said that you view permanent equity as a infinite time vehicle. Is there, and as we also have discussed, that may or may not happen. You'll be able to extend, but for how long, et cetera. Is there a way, or do you guys even want to consider this as a possibility to make this permanent? Is there even a way to make permanent equity or these vehicles that you've created, these closed-end funds, permanent?
Yeah, I mean, we certainly can, and we explored a holdco structure, which would functionally be permanent. Honestly, the difference, we get so much better flexibility with what we have now than a holdco structure. We don't have to value assets. We don't have to value people in and out of it. It's just cash, right? We like cash. So one of the things that just drives me crazy is in a lot of these holdco structures, you have to be constantly valuing things, and everyone's going to feel overvalued or undervalued, right? Depending on who they are. And so, we have mechanisms in place to get people liquidity if they want to. But for the most part, I mean, look, we're sending out pretty meaty distributions, and that's what our investors like, and that's what we like. And by the way, we're perfectly incentivized that if we have a better use of the cash, and we set a really high bar for reinvestment, but if we have a better use of cash and we can reinvest that cash in high probability, high rates of return projects, man, we are excited to do it, right? Because we're going to just defer some gratification and get a lot more on the back end. In terms of making it more permanent than it is, I mean, God, 3 decades is an eternity in business. And I mean, the fact is that we can renew a year 25 for a long time more. I mean, I don't know many things that are still around after 50, 60 years, period. And I'm not worried about the investors we have and the people we've involved. Everyone wants the same thing. They want to see people thrive over the long term. They're excited about that. So whatever comes of the businesses, I mean, look, maybe I get hit by a bus next week, right? Somebody will, you guys will forget about me in about a month. So, I mean, look, there's going to be people that come and go. I'm not too worried about it right now. And we have a long, long, long ways to go.
I respect that. That makes sense. I mean, it's what makes sense for you. And that's what I really respect, is that you're not just conforming to the ideals of your industry, the permanent equity, the private equity industry and such. You're conforming to what works best for you and your organization, which I think is very rare to see. So,
yeah, I mean, maybe a little bit. I would say I think we're conforming to what makes the most sense for the companies that we serve. And I would say that's always been our North Star, right? It actually doesn't make the most sense for us. Man, we could get way more fees. We could make way more money if we had a different fee structure. Look, flipping companies and selling them, like, very profitable. I don't know if you've noticed, but private equity industry makes a bunch of money. So in terms of what's best for us, I would argue in the long term, it's certainly the structure we have, but you got to have that long-term attitude. And I would say is that the thing that's been our North Star is if we buy super high quality companies and get to partner with people that are high quality people, everything else is going to work itself out. It's when you start deviating from those things, which is the norm in private equity, that you get into some really funky situations. And yes, are there going to be great outliers who make a bunch of money in private equity? Of course. Yeah. Are there smart people who do it the right way? Of course. Are there high integrity people in private equity? Of course. I just don't think the incentives are set up that way. So I think that you have to almost be an outlier in traditional private equity with the incentives that are there to be that long-term, thoughtful, kind, generous person. Whereas in our structure, frankly, we force virtue. I mean, it's interesting to think about it that way, but I mean, it's like we're forcing our investors to take an incredibly kind long-term view where maybe they wouldn't. I mean, we have, I don't know how many investors we have, a lot. Not all of them are going to have the same set of values, but we force virtue through a structure that we have, and we force that virtue to serve the companies and the people in those companies that we have.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.